Welcome to the Broken Pie Chart Podcast, episode 382. I'm your host, Eric Moore. Back with me once again, Mike Snyder and Shane Skinner. Jay Pestercelli is on assignment. Okay, now nobody's on assignment this week, and I got no reports from the assignment from either of you guys, so very disappointed in that. Yeah, no, I guess so. I am, you know what? Jay doesn't know this yet, but I think for episode 400, him and I should do that one. We'll see. I'll see if he's around that day. All right. So anyway, the Fed did nothing and spoke softly. According to, Semaphore, they put a chart out. The word count of the Fed's post-meeting statement, and the audience, you can't see this, it, on the high side, 300 words, but I think it averaged close to 300 words under Jay Powell, under Kevin Warsh, barely over 100 words. Didn't give forward guidance. He didn't do a dot. Now, not putting a dot in has happened before. James Bullard did that. I don't know how many years ago he did that. And the reason why he did, he said, it's kind of silly that we do this forward guidance because we're not very good at it. And I think Kevin Warsh, that was sort of the sentiment as well. They didn't do anything. He said he was committed to price stability. They left employment out of there. They really carved out that statement. And he didn't get trapped into any questions in the press conference. I think at some point he said, I refer to the statement. So, all right, here's my takeaway, and I'll get what you guys think here. I think he did a really good job with the press conference. He was in the Federal Reserve previously. Like, people forget that. So he was on the Federal Reserve, he wasn't, and now he's back on as the chair. The market didn't like it, but the market got over it and was fine today from it. I still think everyone is wrong that he's going to raise rates. It's my opinion. We don't necessarily do anything about it. We buy, we hedge, we buy, we buffer is the core things we do. I think the market's getting this wrong, and I think a lot of the pundits are getting this wrong. In my opinion, raising rates will not lower the price of oil. It will not lower certain prices that they think, and it will continue to hurt housing. And the reason why housing costs have not gone down is because your cost of ownership is up. Cost of renting is up. If you own a building and you're paying loans on it, cost of capital is up. So, but I think in general, he availed himself fine. And maybe this was his chance to say, I am independent. I'm not going to just come in and lower rates. If it was up to me, I would lower 100 basis points and be done with it. Mike, let me go to you first.
Yeah, it was a different press conference, I think, than we're used to seeing. He didn't have a template he was reading from, really. And, I think one thing he said that I thought was interesting is that markets should react to news based on how they think it affects the market, not based on how they think the Fed thinks about that news. So, he's trying to avoid leading the markets. He doesn't think it's helpful to provide forward guidance. Now, whether he does in the future, we'll see. And he said, when we have something important to say, we'll say it. But, when we don't, we're not just going to come up here and read a template. So, for now, he's got, it's his first one, and pretty much any question that was asked, he deferred to the task forces and, to see what they'll come up with. So we'll see, but definitely different than what we're used to.
Shane, I mean, that was one of the things that I took from it as well, the task force and his criticism of the way we measure a lot of things. It's very lagging. And there are modern sources, like we've talked about Trueflation, that's one of the sites, or other sites that seem to do a really good job of measuring this in real time. I think he wants the quote unquote task force to do this. I mean, that's one of the things, whether he's successful in implementing those changes, I don't know. But I mean, Shane, what do you think?
I think that if he's got these ambitions, right, to be more with the times in terms of analysis and interpretation of economic data and what they're actually looking at and using to measure, I think all three of us can agree that there are some rather effective ways out there, it seems like, to measure data. And then there are some ways that are used that don't seem to be as effective, like, say, just randomly calling people's phones and hoping they pick up and give you an answer. There's some aspects that could use work. And I think that it's good to hear that he's coming in and not just being content with the way things are. He wants to make the Fed even more efficient and even better with delivering its goals and managing monetary policy. So we'll see if he's able to pull it off.
We'll see if I am correct, and I've been wrong a lot. I've been right a lot too, but I've been wrong all the time. Doesn't impact the way, I invest or we invest. I don't see it. I mean, you can't tell me that raising rates is going to lower the price of oil and lower these prices. Mike, do you think otherwise?
I don't think otherwise. I think the market still has a concern that raising rates may come, although it seemed to get over it pretty quickly. That was the initial reaction, though, right? Yesterday we saw the market sell off, and I think that was the concern. And today, led by tech, it was a nice rebound.
Market yesterday was like a kid who dropped his ice cream cone or her ice cream cone and cried, and then 5 minutes later they're playing on the swing. Like, it just got over it. It's like, yeah, we were mad for a little bit. We're good now. We're good.
So do you take that as, and this is impossible to know, but do you take that as the market doesn't think higher rates will hurt, or the market doesn't think that rates are going up?
Well, it goes to nominal GDP too. And I think you can have higher rates. If we have growth, I would expect the 10-year to go higher in yield. And that would be a positive steepening because it's due to growth. And it goes back to, I joked yesterday, Shane, with you. What did I say? All you need to know is nominal GDP is over 5% right now. And nominal GDP, so what that means is inflation, it's not inflation adjusted. So when you look at GDP, that's the inflation adjusted number. So in other words, if GDP goes up 5%, but inflation was 5%, well, you had real GDP growth of zero. It doesn't exactly work like that. But I look at nominal GDP, and in the 90s, we had, a lot of times inflation was well above 2%. When I say well, it wasn't 7, but it wasn't 2. And the markets were fine. Housing was generally fine. And nominal GDP in the 90s was above 5%. We had a long stretch where nominal GDP was below 5. So, yeah, Mike, I think the market is like, oh, this isn't good. And they're like, yeah, I think it actually is okay if rates go up on the long end. They could make rates a percent tomorrow. But if there's GDP growth, nominal growth, I would expect the long end to still be robust. I don't know. Shane, I think I said that to you. What did I say? And by the way, I don't mean all you need to know is look at nominal GDP. But there's a correlation between the 10-year over a long stretch of time and nominal GDP growth rates.
No, I agree. And I think that I'm going to go out on a limb here. Again, how do you know?
Do it.
Right? We'll find out when we find out. But, if the adjusted measurements for inflation from this new Fed end up seeing lower inflation than what was maybe previously being calculated from prior methods, you've got strong GDP, you've got strong forward earnings. Things seem to be pretty stable other than the shock of oil, right? And just to remind everybody, hey, front month crude futures are trading at 75.39 right now. We're sub 80, almost sub 75 on oil. So I think we're in a really interesting spot because I think this is almost like a fork in the road here. If we're out of the woods, the oil thing calms down, I think inflation numbers might start coming down in the future, right? CPI, PPI might ease up. If you get that and everything else looks good, you could make the argument, oh, you don't need to cut if things are strong, but I think they're going to cut anyways.
Don't you think though, Shane, like you made the mention, inflation might be lower than it is. I would slightly disagree, but I'll take your point is correct in that it could be lower than it is because a lot of the stuff is lagging. And if you use stuff that's more real time, the converse of that or the inverse of that, Shane, we knew inflation was coming in 2021, but you look at how lagged like the housing data was and some of the other things. If you're using real time stuff, maybe the Fed would have realized, and again, I disagree that anything they did lowered inflation. It was a supply side thing. But don't you think, Shane, like if they had real time, not real time, but non-lag data, they would have saw that inflation was already in the data before it showed up in the data. Like there's the other side of that. Like if they just, it's better info, right?
Right, exactly. And I mean, that comes with better tech, maybe approaching the research and the development of their tools and systems that they use to accomplish those measurements. And I mean, these task forces that he mentioned, it sounds like Mike and I were talking about this morning. I'm interested to know who is on these task forces, and I'm sure we will know at some point. But I don't think it's just going to be Fed members, right? Like it's going to be people out either in the public or private sector potentially, as well as maybe some academics. It sounds like he is trying to almost open this up a little bit more to maybe accomplish what you just described, be more forward looking and maybe be ahead of the curve on some of this stuff instead of behind, so that they're proactive instead of reactive.
There's little stuff too. Like Mike, I know you're intimately familiar with every detail of every way that stuff is measured. But for example, some of the stuff that the BLS uses, so I'll give you an example. BLS is Bureau of Labor and Statistics for measuring the CPI index, Consumer Price Index. And the basket of things that they're measuring, it's like everything from soup to nuts. But you don't buy as much soup as you buy gas for your car. So it's weighted. But what if I told you that I think, and I think I'm right on this, that the weights that they use today are based upon consumer spending patterns from like 4 years ago, Mike. Like stuff like that, that seems like, why are we not updating these if people are spending stuff on different things?
Right. It seems like we have that data to be able to update, and properly weight those things, I mean, on a quarterly basis, right? If we have the data, I mean, that can be updated in real time.
And I'll just close with this. All of this stuff can be updated. It can be changed. In fact, we changed the way we measure inflation in the 80s, a major change. Like prior to, if we measured inflation the same way we do today, the 2021 inflation might have been on par with the late 70s. Like you measured different things and there was this adjustment. Where this gets difficult though, is how you measure how you're doing today versus historical. So I'll give you an example. Like if you change the way you measure something and you have the data that you can go back and change what the numbers were 10, 20, 30, 40 years ago, then that adjustment is okay because then you have a historical comparison. But if you don't have any way to measure, if you can measure things really good, like the Zillow rental index, it's real time. It's what people are posting online and doing transactions at, or the Zillow home price index. Like that's real time stuff. Those are transactions that are happening, but they didn't have that data from way back when. Okay. Should we talk about SpaceX? Want to go there? And we got to talk about strategy or Michael Saylor stuff. SpaceX, today it's Armageddon. It was down just under $7, right around 185. I'm kidding. It went up, it came back down. The options are out. Mike, you and I said last week, Micron is probably the corollary here. Micron has about 100% implied volatility. I'm looking on Bloomberg for the July 17th options. The at the money today is right about a 90% implied volatility. That's high. I don't remember what I said, Mike. Did I say? Well, I think we agreed right around microns. It's close.
Yeah. We said right around micron, so not bad.
So you a buyer or a seller of the at the money straddle? I'm kidding. No, this feels like the right vol. I mean, what did it move today? So it was what, 192. I'll just kind of generalize this. So if, what percent did it move today? I'm on a Bloomberg screen. It doesn't have the percent, unless you guys can chime in with that. But if I say, 185 divided by, I'm doing this, live. What is this? 191.82. 191.82 minus 1. Okay, so it was down like what, 3.5% today? 3.6%? Does that sound right?
Yep, exactly.
And a 90 vol basically is saying the expected one standard deviation move is 5.67. So based upon today, you would say, well, vol's too high. The day before, you would say vol's not high enough. So I don't know. That feels about right. You agree?
Yeah, I mean, it has to be high. There's only been
it has to be. Yeah.
There's only been 5 trading days now, and if you think about market makers who are taking the other side, like they have to be paid for the risk that they're taking. It's hard to know where the stock is going to move, because there's just nothing historical you can really compare it to in terms of the size of the IPO, in terms of how popular it was, in terms of the subscribing of the IPO. We were also talking about the lockup, which we didn't mention last week, but we talked off air, and the lockup is a concern for a lot of people when that expires, because then there's more shares that are available to be sold, and you assume that a lot of people are going to take profits at that point. The flip side to that, Derek, right, is that the indexes now, because there's going to be more float, may be forced to buy more shares.
Yeah, the example that you and I thought about is when Warren Buffett sold a big stake in Apple. A lot of people said, well, and by the way, you find out about it unless they announce it in the 13F after the quarter's already ended, after they did it. But that's an example. And what he did, those were not considered free float. So even though he was selling all those shares, the float went up, the indexes had to buy more. So in a weird way, him selling that big block of stock, it causes it to buy more. So yeah, like the weighting could go up in the indexes, and Shane, that means, guess what? Like the Q's got to buy more, right?
Yeah, exactly. And I think that there's an argument that passive flows might then maybe stabilize the stock a little bit. But at the same time, I mean, look at breadth. You have plenty of names, big and small, across the S&P this year and the NASDAQ, that, the index itself is up a tremendous amount simultaneously. If you're trying to pick winners and losers inside, you just don't know. And so, Derek, I think you mentioned that the amount it's going to take up in the NASDAQ really, it's like 0.5% initially, just under that, I think.
I haven't run my estimated calculation. When I did it, I think it was 0.6.
Was it 6? Okay.
0.7% weighting. And
okay.
Yeah, to remind the listeners, it's you free float adjust the weighting in an index. So even though in aggregate, all of the shares, it had gotten up over $2 trillion, but it's not going to have a $2 trillion weight in the NASDAQ. And if it gets into the S&P, that's right. So I don't know, Shane, you weren't on the show last week, but Mike and I just kind of said we thought it would be the IV of Micron, which Micron's is 100. You made the point, and we were talking today, the three of us, like, yeah, this has to settle out. If you're a market maker, you have to price it high enough that you're able to hedge your positions, and people have to pay for that uncertainty. Like at some point, this stock settles in. Maybe it goes higher, maybe it stays the same. But It's really early to have options, by the way, on something.
Yeah, I think we talked about that earlier this week and how that was really, really surprising. But I will also say this, and this ties back into the Fed and this just in general with markets, right? Markets are always changing. Rules change. Regulation changes. Things change, right? Sometimes for the better. Sometimes stuff gets walked back after a little while. But at the end of the day, we're in 2026 now. If this was in 2016, I think people would have freaked out that options would be added to something so quickly. But it's just the nature of the market now. I mean, options are everywhere in all major names. And if something is going to be in the NASDAQ, wouldn't you guys think that something that is about to be in the NASDAQ probably should have options on it? I don't know if that's ever happened before where a major name enters that index and doesn't have options, but I could be wrong.
The other thing, and I should research this, what the borrowing cost is on SpaceX. So in other words, if you want to short a stock, you have to borrow it. There has to be shares that are marginable in a type 2 account at a brokerage. Remind me, is SpaceX marginable yet? Do we know that? This is what happens when we do come up with topics, but we don't actually prepare the
According to Gemini, Google Gemini says that it is currently marginable, but not all brokerages permitted immediately. Standard regulatory restrictions cause many brokerages to prohibit margin trading on newly public IPOs for their first 30 days of trading, which is a standard requirement. That's according to, again, Gemini. So
I'll find it by the end of it. But so this is something else that comes up though. And if the borrowing costs are high on a stock, then the cost of the puts are going to be higher. And you see that sometimes if it's a hard to borrow, because the only way to bet against the stock then is to buy the puts. So I'll find it out. I know another place to search, but that is something to consider as well. And the fact that you have options, if it's not marginable and there's not a lot of stock to borrow, if at all, then there's actually a way to bet against it using options. So it's kind of an interesting point as well. All right. Did we kill SpaceX? Are we good on that?
Yeah.
Oh, I need your prediction, by the way. It's a little unfair because Mike and I did this last week, but Mike, what do we say? It wouldn't surprise us if it's at 100 or 200. And it went above 200, range. Right?
Yeah. Monday it was at 220. I was like, well, that's dead.
I said I wouldn't surprise either way. I was more, you took the bull case and I took the bear case just because you took the bull case. Like, I don't think any of us had any conviction one way or another, but Shane, what do you think? Where is it in 30 days?
We've gotten 200, we're going to get 100. I think it's very possible we see this drop down to IPO price or even a little bit lower, and maybe base down there for a little bit. We'll see. I'm going to say I think we're trading in 30 days right around where we're at right now. Let's call it 180. We're at 185 on the close today. I'll say we're at 180 30 days from now.
You know, in the there's this whole thing Schiller does when he taught at Yale. I've seen this thing, and he does this our markets are random lecture, and he gives this example of if you were to try what does he say? A guy who's very drunk at a bar and steps outside. Where is he most likely to be in the next hour? And the most likely area is right in front of the bar. Because maybe he wants to go back inside too. You know, that's right. The other part. So that's what you've just done. You've said this is random, but it's likely it's right here. I got to be honest with you. If you were long a butterfly, I'll bet you the butterfly is pretty cheap at 185. Meaning
with the vol.
Yeah, it's the options market's not pricing in that it's going to be exactly here in 30 days. is what I'm saying.
Saying it's going to be anywhere but here.
It's going to be anywhere but here.
That's why it'll be exactly here. Please don't trade this. But
I think you should buy a butterfly. I think you should buy the butterfly with the middle strike at 185 and the wings, 5 wide or something.
You could do a 185 and go 15 up, 15 down. That puts you at 170, 200. That's a great range here. Slightly above IPO, but not above.
But even though it's and again, I haven't even looked at it, but knowing the vol, I know it's relatively cheap. Even though I say it's probably relatively cheap, it's cheap for a reason, because the options market is saying, no, it's probably not going to be right around here. But you're literally saying 185. Okay, Mike, do you have an updated prediction? I'm going to give a range. Just Shane said it's going to be 185, but no update, Mike? No range?
I think I got to move my target up to 220 now on the upside.
Live a little bit. Come on, 230.
All right, yeah. The way that this thing moved up to 220, I was like, this thing could be at 400. I mean, it really could.
Yeah.
But yeah,
I'm going
100 to 230. So there you go.
I'm saying 100 to 300. And Shane's saying it's going to be exactly where it is today in 30 days. That's how you make a market, folks. Mm-hmm. By the way, at Schwab, SpaceX is marginable, I believe. Okay, but here's the thing. It is special maintenance of 100%. So
it will be marginable after probably the 30-day period, I would guess.
Yeah, I mean, they have special maintenance of 100%. So normally that means it's marginable, which means it can be borrowed for short sales.
Oh, okay. So then it's marginable and they've upped the holding requirement.
They're holding it 100%. Yeah.
That makes sense. Yeah.
Which, by the way, if I'm a brokerage firm, I do that because brokerage firms make money on loaning, rehypothecating shares for shorts. So
makes sense.
I would do that. Okay. Enough with that. Let's talk about, all right. Shane talked me into this. We're going to talk about Michael Saylor, Bitcoin, and strategy. Let me set this up for everybody. So they issued a perpetual preferred that came out at par value $100. And a preferred stock, if anybody's not familiar with these, it kind of trades like a stock, but it has attributes like a bond. And a perpetual preferred, sometimes they have call provisions in it, but basically they issue this preferred. And preferreds are actually to me anyway, they're a really interesting thing. There are these random stray preferreds that were issued 40 years ago that are still out there. But often they either have a fixed coupon, there can be variable preferreds, but often they're fixed. This one is a creation where they've issued this preferred. So a preferred is considered debt because if you're a company, you issue a preferred to generate cash, just like you issue debt like a bond and you generate cash. And for that, you pay some rate of interest. The preferred, if I'm looking at this right, I'm going to look at your document, not your document, your link to strategy. And basically, their current dividend it's variable, 11.5%. It's not trading at 100. It's trading at 88.59. And there's some consternation among people because they believe that it was going to be pegged to 100. I don't believe there's any peg. I think what the company has said, just doing a quick search online, is that if the price dropped from 100, they may increase the dividend to, encourage the price to go higher. At the price right now, because just like if you buy a bond at lower than par value 100, you look at the effective yield, which is the difference between 100 and the 88.59 plus the dividend. And I think the effective yield is something like just under 13%. So there's a lot of, once you turn me on to this story, Shane, like there's a lot of people being like, oh, this is crazy. They were supposed to keep it at 100. I got to be honest, I I haven't read the offering documents. I may do that this weekend because that's just something I would do. But let's be honest, MicroStrategies is not doing well because Bitcoin is not doing well. Like, that's their business. They own Bitcoin. And I also sort of notice, I feel like on their website, a lot of the stuff that was on there isn't on their website anymore. Like their Bitcoin yield and like the return 1 year, over the last year. Did you guys notice that? I haven't been to this website in a while. Like if you go to strategy and you click on MSTR, didn't they used to show the return? Like they're taking stuff off here. I'm not saying that's indication of any untoward actions. I'm just saying a lot of info they used to put on here, they're not putting on there anymore.
Minus 70% 1 year return is really the only return I see listed there. I mean, I just brought this up because it really blows me away. We were talking about it before about, how most preferreds are tied to interest rates. I'm going to take the opposite side and say, I don't think this preferred trades in any way relative to interest rates. I think it trades relative to like the distress level at MicroStrategy. If things are going well there and Bitcoin is up, I would assume this is way more likely to trade near 100. But I've never heard of this, and maybe this is more common than I realize, and I just am not aware of it. It really blows me away that the board sets the dividend monthly, and I would assume if this keeps going down, they're probably going to raise the dividend, not lower it, to try to make it more attractive, to try to encourage more buying of this.
Well, this is where you get into, I think, the reason it's down, and that is their whole mantra was, we're going to lever up Bitcoin. We're going to do it better than you could do it on your own. We're going to create some sort of metrics, whatever, Bitcoin yield, whatever the heck they call it. But they do have to pay those dividends. And so, their business, I don't know how much free cash flow they're bringing just from the business. And so basically, they sold some Bitcoin recently. I think they bought some too. Let's see if this was sold or bought. But anyway, yeah, I mean, no, I don't think this is odd because people are saying, wait a second, if their core business is not necessarily bringing in cash and they don't have cash, they either have to go to the debt markets to get more cash or they have to sell some Bitcoin, which kind of goes against their whole thing. Mike, I would say a preferred, though, in general, it is interest rates, but it's also the ability of the underlying company to pay the dividend. And so we've seen this where preferred stocks drop if there's thoughts that the underlying business, the cash flows and their revenues don't really support it the same way that a bond would. There's a reason why bonds are rated as, junk bonds versus AAA, because the company's ability to use cash flows to pay that, right, Mike?
Yeah, I mean, at its core, it has to be based somewhat on what interest rates are, right? So you have some sort of baseline level of risk that you're taking versus what, the risk-free rate is. I think Shane's right, though, in this case, it's selling off not because really of interest rates, but because the market's telling you that at its current dividend, it's not worth the risk. And so it's kind of saying, they have to raise the dividend in order for the risk that you're taking to be worth it. And then at a certain point, it sort of becomes a game of, well, can they pay that higher dividend? And does it then continue to sell off because, okay, the dividend's gone up, that's nice, but what are the odds they can actually pay that based on their business model? Because you're right, this exists so that they can buy more Bitcoin. So if they have to sell Bitcoin to pay the dividend, then that's not a very successful strategy.
Well, I think the other part too is Bitcoin is down. Like, I'm sorry, but if your business is owning Bitcoin and Bitcoin's down, that's not great. So, and one of his pitches was, so the view for and I think Michael Saylor has said that. Like I infer from his media appearances that he believes Bitcoin is going to go higher. I don't think it's in his base case that Bitcoin would go lower. If I look at the purchases, their average Bitcoin purchase price is $75,656. Isn't it 65,000 today? Yeah. So, I mean, basically, yeah, you've bought Bitcoin higher than the price today.
Their average price is 75,656 according to the website.
Right. But what's the price of Bitcoin?
64,000.
Right. That's what I was asking for.
Yeah.
Yeah. So they
1,000, and they have 846,842 Bitcoin.
Sure. And like we pointed out, I don't remember what episode we did this. The debt has something interesting. They have a put provision. So roughly, I think it's, if my numbers are right here, $1 billion of a bond, a convertible bond, converts in 2028. But the maturity is 9 of 28. They have a put provision, 9/15 of 2027. Many people are familiar with a call provision where a company could call the bond back in. Here, the investors have a window where they could actually put the bond back to the company, and they would have to pay. It might be par value. I'd have to take a look. And this could convert into shares, but the conversion price is 183.19. So if you own this bond and you're below the conversion price, like maybe you don't convert into it unless you believe, okay, I don't want to do the put date. I will wait until it actually matures and maybe it will go up. But in theory, they'll have to come up with $1 billion if everything gets put to them. So, but Shane, I think the reason why, if you look online and if you want to waste a couple hours, you can go to, Reddit or some of these forums. It seems like people thought that this was absolutely pegged at $100, not that the company would do something that might encourage the price to go back up. Like, do people think this is actually guaranteed? Like, oh, I can't lose money. It's going to be 100. Like, is that what people are saying?
Yeah. I mean, I think people thought it was free money. And this is really more so like almost like a high yield or sort of credit product, right? It's not ownership and MicroStrategy. And, Mike pointed out in the wording for this that it expects it to trade near 100 based on just the way the product works, or the way it's set up that will encourage trading around 100. And yeah, I mean, I think this is just a perfect lesson for, the people listening, that when you see something that says really good yield, anything at 10% or more, you're talking about that's yielding something better than what the market returns on average. You should probably think about what the risks are within that. Not that it's not necessarily fits your profile or what you want to invest in, but it's, there's no free lunch, right? And the higher the yield, the more the risk. I think that's what we were taught in finance school. I could be wrong.
Remember, the risk-free rate right now is the 3-month treasury. Any return that you're seeking above that, and the risk-free rate is really the next 3 months. That's what you buy a 3-month treasury bill, unless the U.S. government defaults, you're you're quote unquote fairly certain, can't say guarantee, but fairly certain you're going to get that's what you're going to make on an annualized basis. So if something is 11.5, do the math. 11.5 divided by, rounded to 3.6. That's how many times risk you're taking. So,
did we beat it up? Did we do it? Thank you for diving down this. And
as far as, Mike, I think a lot of preferreds are fixed, but I know we've seen variable preferreds, and variable preferreds are interesting sometimes if you believe interest rates are going to go up rather than a sort of a fixed coupon, right?
Yeah, I would say the more common ones that you see are fixed, but yeah, it's not that rare. I don't think that you see a variable. And I think this one would have to be variable. I mean, just the way that this company operates, I can't see how they would do a fixed preferred.
Yeah. I mean, I'll give you an example. And we use a buffered strategy. We use very short duration, high yield bonds and loans and, senior loans. And the senior loans, they have a rate floor, a minimum that you sort of receive. So even if I was going to say LIBOR, it's not, it's SOFR now. But when LIBOR was, next to zero, there was a floor. So the loan still had to pay a certain amount of interest. Those are variable though. They have a floor, but they're variable. And so as interest rates are going up, a lot of times you would see the dividends go up. So variable products is not unheard of. And yeah, I mean, a company could vary the rate, but it all goes to why do either people don't want it, people don't believe, or their perception is, the strategy is they're not going to be able to cover the dividend payments. So
they do have a fixed preferred. It looks like STRK.
They have a fixed preferred as well. Okay.
Yep. Pays 8%.
All right. I mean, I'm looking at all the preferreds. Yeah. So they have STRD, STRK. Some of these are fixed. And what's the fixed symbol? Did you get that?
STRK.
Okay. That's the one I thought it was. So yeah, that price is $60.53. So the 1 year return on that is minus 34%. And fixed dividend coupon or fixed dividend of 8%. The effective yield today is 13.22%. So, yeah, I don't know what to tell you there. Here's the thing though. There's really two camps on Michael Saylor. There's the people who think he is right and everyone else is sort of out to get him and wants him to fail. And then there's the camp that really wants him to fail and cannot wait for him to fail. And I think the three of us, I'll speak for you guys for a second, we're more like observers on this. But when people come to us, and I have it all the time, not much, I actually think nobody really, I'm not going to say nobody cares about crypto these days, but nobody's really asking me about it. But when people bring this stuff to us, we're like, we just sort of unemotionally, objectively look at it. And you go back to, as you said, Shane, like Finance 101, like what is the instrument? What are the terms? If I was really investing in any of this stuff, I would look at the prospectus and, look at this stuff. I'll just ask you guys, like Shane, does anybody care about crypto anymore? It doesn't seem like it. We said this is the risk. People get apathetic about it.
Well, I think that what you're seeing is the crowd that's always been in crypto. I think they're always going to be in crypto. I think there's some turnover there, but it's not that great. Like the people that are in it, right? What I think's happened is that since the release of the ETFs, and more especially over the past year, I think there was a lot of excitement and hype around crypto coming into the election, with the expectation that there's the potential the administration does something, right? With Bitcoin or Ethereum, creates reserves, maybe starts adopting stable coins, and there's still plenty of time between now and the end of this term. So there's lots that could happen to make crypto a little bit more relevant again than it is right now. But yeah, I mean, if you look at that market across the board, I think it's all fairly correlated to Bitcoin, meaning that I think most of the crypto space and the names within that space are naturally correlated to Bitcoin. And again, if you look at Bitcoin's sort of cycle that it's traded in throughout its life, it suggests that it's not necessarily going to catch a bid until like October of this fall, I think. And so again,
tell me the exact date when I need to buy Bitcoin. I'll buy it the day before it's going to catch.
I will give a prediction. Next show, I'll give a prediction.
Don't do that. Yeah, we don't want people.
No. But yeah, I mean, it's nobody I know is talking about it anymore. Everybody's excited about the AI trade, and I mean, friends that I had used to be trading crypto are now more, they've almost like grown out of it, if you will.
Well, AI is really okay. AI has really replaced the crypto, and blockchain is going to change everything and get implemented into every business, and everything's. I think you're right. AI has replaced that. AI is now going to be embedded in businesses, and it's almost like no one is talking about blockchain technology. Like I don't know. All right, a couple other things. I'm done talking about Michael Saylor and strategy. Leading economic indicators. Liz Ann Saunders tweeted this out. It's a Bloomberg chart. The Conference Board LEI, leading economic indicators, rose. And if you look at the graph, I mean, the leading economic indicators, but for a few green bars, I would say since December of 2021, the leading indicators have been bad. 3 of the last 4 months, they've been green. And you go back, I mean, it's 1, 2. Here, I'll even, cherry pick this. Let's say we go to, what is that, February or March of 2022. Since March of 22, there were 2 green bars, 2 green months up until, I would say like March of this year, and 3 of the last 4 is so like the leading economic indicators. I don't know how leading they are if since 22, this has been red. Like clearly the economy was better than people thought. Mike, I know you love economists and you try and play one. Any thoughts here?
Yeah, I wouldn't have expected to see so much red, given sort of, where the market has gone. And I agree. I mean, I don't know how leading it is if, the past 3 years, there have been only down months or down reports other than 3.
Don't you think it also syncs up with what we were talking about, the economic surprise index, where the economic surprise index is high if the numbers have exceeded the expectations. And when it's negative, it means that things are worse off than people predicted. When it's good, things are better off. Things have been better off for a while than people have been predicting. So I don't know. It's maybe these aren't the right indicators.
Yeah, that's sort of my takeaway is that I haven't followed this too closely in terms of the leading economic index. I'd be curious to know what all goes into it, but yeah, it sort of doesn't seem as relevant as you might hope.
Shane, we always come back to earnings, and the S&P 500, when I pulled this, was exactly at 21 times forward EPS estimates. Shane, EPS growth, still analyst predictions, analyst estimates, not certainties, over 20%. Sales predicted up 10%. Net profit margins, analyst projections at 15.75%. So it's always comes back to earnings, but sometimes the multiple goes up or down, multiple contraction, multiple expansion. Shane, the end of the year. So give me the bull case and the bear case. End of year, why the multiple increases is higher on December 31st? Why is it lower?
I think it's higher if things calm down with oil and energy and inflation calms down. I think that market is thrilled if that happens and we're poised to see more growth and run higher. I think it's lower if the inflation thing gets stickier and rates potentially stay where they're at or go higher because of the situation going on. But it looks like there might be a resolution. As long as the oil thing resolves, I think the market's primed to continue to do well, unless there's something under the hood we're missing.
I mean, if we go from 21 back to 23, That's 700 S&P points, just increasing the multiple. Now, flip it the other way. You go to 19, that's 700 S&P points to the other way, the wrong direction. So, Mike, get you in here.
Yeah, I mean the estimate or the PE can also change, right? Based on like the market could move higher and earnings stay the same. You know, that could also be a reason that you might see that expand. You know, let's say interest rates are cut and it's sort of a surprise and the market runs on that, earnings sort of stay sideways. That could be a scenario where you see that multiple expand.
I mean, what we've seen though, Mike, is earnings have expanded.
Right. We have not seen that case at all. Yeah. Earnings continue to grow and support it.
But the market's up because when you do the math, earnings have gone up more than the multiple contraction has hurt. So the market's up because earnings are up.
Right.
I mean, that's kind of what we've seen. So I always go back to earnings, and right now the earnings estimates are good. Last thing I'll bring up. So we run a strategy with, we partner with a manager, a value, kind of value growth manager, dividend growth value manager. And it's wild that the Russell 1000 value index, and you guys know this already, but for the audience, like think about it. What do you think the top stock is in the Russell 1000 value? And then if I told you these three companies, would you be really surprised? So think about that in your head for a second. Okay, the top company from a weighting basis in the Russell 1000 value is Micron. Intel is in there. And SanDisk is in there. So, I don't know when they rebalance if some of these companies will change. Micron has a very low forward price to earnings. I think there's a price to book component in that index too, although I'm doing this from memory. I mean, I don't know what their book price is, but yeah, like if you're a manager and you're a value manager and you didn't have Micron in there, like it's crazy that you're trying to beat an index where the highest rated company or the highest weighted company is Micron. Like, did that surprise you when I told you guys that?
Yeah, I mean, this is a different market and a different world that we're living in terms of value and what you've historically thought of as value, right? I think when you think of value historically, you think of a company like Procter and Gamble or Coke or Pepsi or something like that. Yeah, I mean, the way that Micron moves historically you would not think of it as a value stock with the amount of volatility that it has. I mean, does it pay a dividend? It does pay a dividend. You also historically thought of value stocks as paying dividends. Micron's dividend is 5 bips, 15 cents.
It's nothing. I mean, think about it. Intel, I thought of Intel as a value company. We would sort of say, I guess it's a value play now. When Intel was really doing bad before the run. Like Shane, it's Intel, yeah, legitimately, that's a value stock. Like people looked at, I think Apple was in some value indexes. I got to go back a few years where it really didn't move and their forward PE got down and price to book was lower. So, yeah, I mean, the S&P right now is trading at, let me see what their book value per share is, 1,518 per share. So I'm just going to do the round math, 7,500 divided by 1,518. So it's trading at just under 5 times book. I guess I could pull up, if I could find it, Micron's. Let me do that actually. So now I'm curious to see what they are. MU, Micron is the symbol. Let's see here. Hang on. So Shane, you weren't surprised though, or maybe I already had this conversation with you.
No, I wasn't surprised. And I mean, I have a chart somewhere. I'll get it to us next week just so we can see it and talk about it more. But it's a chart of the most what's called like crowded trades, right? I'm sure that over the years you've seen many crowded trades, right? This chart showed a ton of different ones. And would it surprise you that semis are at the top of that list and have been for the past year or two? Gold's been up there recently too in one of the recent years, but like it just seems like everybody's piled in there, and it's like you said, it's almost like self-reinforcing when some of the biggest names in the market are in that area, and the passive flows continue to buy those funds that have those things in, and then it keeps running. But also too, I think we shouldn't sell short just how much demand for memory exists with this AI build out. And we've been talking about all these future possibilities, what the Fed's going to do, what businesses are going to do with AI. It's going to be in everything. It's going to be in the infrastructure. And so to do that, it's going to take a lot more memory than I think people realize. And that's why you've seen it run the way it has. And
but I go back to why it should be in the value index. Like if you're a value manager and that's your benchmark, and I know people who have that benchmark. To give you an idea, price to book next 4 quarters forward on Micron, Bloomberg is showing 13.70. What did I say the S&P was? Like just under 5. So is that the right measure? I think the Russell 1000 includes that in some of their estimations, but all right. And by the way, if those big companies fall and that's your benchmark and you don't have that stuff, then like good for them. Don't have it in the benchmark. So I'll be curious if they do a rebalancing, what happens there. All right, let's go to recommendations. Shane, I'm going to come to you first.
Well, I can't believe this is happening, but I'll be taking my son to see Toy Story 5. I never thought that Toy Story would still be coming out when I had a kid, but here we are. I'm excited. There's a drive-in near us. I know there's not many of those, around anymore, but it's really cool. Super cheap. It's like $5 a person. You get a double feature each night, and the concessions are cheap too. So it's hard to beat that nowadays. But
so this is a pre-recommendation.
It's a pre-recommendation. Okay. I will report back.
Mike, what about you?
I'm going to go with the World Cup. I'm not going to say the U.S. Open, which will be over by the time this is released.
Good idea. You've done that in the past, yeah.
Right, I've learned. The World Cup, I don't really ever watch soccer, football.
Football, yeah.
But I've watched a few games. I watched the U.S. I watched some other games, Croatia, England. I had on in the background. I mean, some of these games have been pretty exciting, and just how much the fans get into it, the atmosphere, the fact that it's a lot of these games are being played in the U.S. and Canada and Mexico is pretty cool. So yeah, I'm gonna continue to watch that, especially without any hockey.
No hockey is rough, I'll admit. And no basketball.
I'll throw it out there since you mentioned the Cup, Mike. Did you see on Tubi that they're doing a show called The Other Football, and it's hosted by Rob Gronkowski and Jameis Winston, and it's these guys doing soccer, and it's actually kind of funny because naturally, NFL football players don't usually have much to do with soccer or football around the world. It's been fun watching that.
All right, I'm going to go with a book called Tunnel 29. You guys may make fun of me because I read this stuff. Tunnel 29 is the true story of an extraordinary escape beneath the Berlin Wall. Helena Merriman is the author. It's a nonfiction book detailing the true story of a daring escape tunnel built under the Berlin Wall in 1962. So I'm through a bunch of it. It's pretty good. I kind of like it. So there you go. A random nonfiction book, Tunnel 29. Thanks to Audible. I was listening to something and then it suggested it for me. And I said, yeah, I'll give it a shot. but I'm reading the book, not the audio. All right, no reaction to that. All right, good.
I'm just reading about it right now. A 22-year-old who escaped from East Germany in 1961. That's, I mean, a pretty incredible story, I'm sure.
Well, in the forward, the author talks about there's all these diaries she got access to. So she read both the East German, some of the the agents, their notes on some of the characters, and then there's just different materials and there's pictures and different stuff available that she sourced. And I think she was able to interview some of the people too. They're probably much older, but so there you go. There's a little book. Hopefully, I think it's a good book. I don't know what the sales are in the book, but maybe people will buy it and read it. I think it's worth it. Let us know how Toy Story 5 is. You guys are both in the zone where you're going to see a lot of animated movies, a lot of kid movies. So I think my son wants to go see the Odyssey when it comes out with me. So I'm in that mode. So seeing the Mission Impossible, Top Gun, that type of stuff. So, all right, guys, we did it. We got to the end of the show. We'll come back next week and see everything we got right and wrong. And until then, be well. Take care, everyone.